What if outrage isn't just an emotion anymore, but strategy? In this episode, we dig into how viral fury has become a new policy weapon. One tweet, one clip, one monologue, and billion-dollar companies bend. When Elon Musk told his followers to cancel Netflix, markets moved. When Jimmy Kimmel's comments sparked a backlash, Disney backtracked. Both incidents reveal the same machine, outrage as liver. It's no longer about truth. It's about timing, amplification, and control. Who actually profits when mobs move markets? Who pulls the strings when reputations become currency? We trace the timeline from tweet to corporate memo, from trending hashtag to stock dip, exposing how performance outrage now functions as a form of governance. This isn't left versus right. It's the war for narrative power, and both sides know exactly how to play the game. The Netflix versus Elon Musk moment didn't erupt from out of nowhere. It was the collision point between a growing cultural fatigue and a very specific kind of content that many parents feel crosses a moral and developmental line. Shows like Strawberry Shortcake and The Very Fog, Transformers Earthspark, and Dead End Paranormal Park were not just ordinary children's programs. They were increasingly interpreted by parents as vehicles for ideological messaging, particularly around gender and identity, that they did not consent to introducing to their children. What makes this moment so significant is not only the content itself, but the climate in which it appeared. Parents today are no longer passive consumers. They've seen similar ideological patterns creep into school curriculums and public institutions, and now into their living rooms through entertainment platforms that they pay for. The reaction was swift and visceral. Canceling Netflix subscriptions became a form of protest, a moral statement against what was perceived as a normalization of confusion, manipulation, and in some cases, covert moral conditioning of children. When Elon Musk weighed in, it amplified everything tenfold. His commentary didn't create outrage, it validated it. It gave it structure and turned individual frustrations into a collective cultural signal. Elon's involvement carried emotional weight because his stance comes from lived experience. His own son's transition and the ideological dispute surrounding it gave him a unique vantage point. So when he called out the kind of messaging embedded in children's media, many parents saw a reflection of their own fears and frustrations. It wasn't just a billionaire that was tweeting randomly, it was a parent drawing a line in the sand. And that humanized the outrage, turning it into a movement rather than a moment. However, Elon Musk is not merely an observer of culture. He's also a strategist with vested interests in media and entertainment ventures. It's not far fetched to assume that criticizing Netflix may simultaneously create some room for new competitors, whether that's Paramount or X based streaming integrations or future projects he may be aligned with. That dual reality doesn't erase the sincerity of his convictions, but it does brighten up the picture a little bit. What began as a moral protest against ideology in children's programming may also double as a strategic play in the long game of who controls the next generation's screens and attention. The Disney versus Jimmy Kimmel episode was, by most measures, the weaker and more reactionary of the two, but still deeply revealing in how outrage can steer billion-dollar decision making. Jimmy Kimmel, a long running late night host who has built his brand around politically charged, I want to say humor. He made remarks following the death of Charlie Kirk that struck many viewers as distasteful and even cruel. The backlash was immediate. Conservative audiences mobilized online calling for accountability. Advertisers began quietly asking questions, and the FCC hinted that it might look into whether any broadcasting standards had been violated, right? So affiliate networks, sensing trouble, began pulling the show from local schedules, not because of any formal directive, but because outrage now operates as a form of anticipatory compliance. Companies move preemptively to protect any perception that might threaten their profits. So Disney, caught in the crossfire, acted fast. The company suspended the program, Jimmy Kimmel's program, temporarily, signaling to the public that It took the backlash seriously and was willing to demonstrate its sensitivity to moral optics. Yet a week later, once the uproar began to lose steam, Jimmy Kimmel was reinstated, the show resumed, and the cycle quietly ended. The whole episode exposed the volatility of corporate reactions when faced with digital outrage: quick to punish, quicker to reverse, governed less by ethics and more by fear of momentum and profits. Now we're at a point where we see the public outrage, regardless of ideology, prove that it could bend the system. The reinstatement wasn't a corporate act of forgiveness. It was a quiet acknowledgement that the outrage machine works both ways, that freedom of speech, at least for now, still finds its balance in the court of public reaction. This wasn't victory for Disney or for Kimmel. It was evidence that the people, when unified in outrage, still hold the final word. We've reached a point where public outrage isn't just noise outside corporate walls. It's data, it's analytics, it's something that gets plotted on charts, and it is also discussed in boardrooms. Companies today don't merely observe backlash, they measure it, they quantify it, and they integrate it into decision-making frameworks. Executives have social listening dashboards open right next to their financial dashboards. They watch hashtag spikes, they monitor sentiment graphs in real time, and they interpret this digital turbulence as policy signals, almost like a new form of market intelligence. When public fury peaks, it doesn't just trend, it translates into action. A meeting gets called, a press statement gets drafted, a project quietly disappears, or an apology video gets scripted before the outrage has even cooled down. The mechanism is fascinating because it shows how emotional energy like anger, disappointment, moral outrage has been converted into a governance tool. What used to be spontaneous public reaction now functions like structured feedback, guiding how companies allocate resources and manage their image. When investors see an online uproar, they preemptively pull or redirect their capital. Marketing teams adjust campaigns midstream, and executives recalibrate strategy, not necessarily based on ethics or truth, but on perception management. The underlying logic here is survival. Corporations now operate under constant surveillance by the public, and the public wills its discontent like a remote control. But the deeper shift here is psychological. Outrage has become a signal of engagement, not rejection. When a topic sparks fury, it also drives clicks, streams, and visibility. The paradox is that the same outrage that forces apologies also fuels attention, and attention is still the currency of the modern economy. So companies don't just react to outrage, they sometimes ride it, they sometimes feed it, or redirect it strategically. So what looks like crisis management is often controlled adaptation. The fury of the crowd has been institutionalized, turned into a kind of feedback loop that dictates creative direction, marketing tone, and even financial priorities. Outrage, once spontaneous and unpredictable, has become part of the operating system of modern capitalism. Celebrities like Elon Musk and Jimmy Kimmel occupy a very particular kind of power in this ecosystem, not because they create the outrage, but because they amplify it, giving it structure, momentum, and legitimacy. When Elon Musk tweets or when Jimmy Kimmel comments, their platforms don't just broadcast random opinions, they trigger an echo chamber that can turn a grievance into a mainstream event. Social media operates like an accelerant in this process. What is interesting is that their influence extends far beyond immediate audiences. Journalists, investors, and politicians monitor these reactions as signals of public mood. This creates a dynamic where a celebrity's emotional expression becomes a form of market commentary, even if it's unintentional. And the companies on the receiving end of this amplification don't just face criticism, they face systemic pressure to respond, to demonstrate awareness, and to publicly align with the emotional tenor of the moment. The celebrity becomes the fuse, social media becomes the wire, and outrage is the explosion that demands a strategic corporate reaction. In this sense, celebrities aren't just entertainers anymore, they are brokers of legitimacy in the economy of outrage. If you look closely at the behavior of financial markets over the last decade, there's been a profound shift in what actually moves capital. It's no longer just quarterly earnings reports, or macroeconomic indicators. It is social sentiment, it's viral reaction, it's the temperature of outrage on the internet. What's remarkable is how measurable this has become. When Netflix faces a wave of criticism, even if the criticism is about creative or cultural issues rather than business fundamentals, you can observe immediate market responses. Stock prices dip, analysts issue cautious notes, and institutional investors quietly rebalance portfolios as if emotion itself has become a form of financial data. This is because markets at their core are psychological systems. Investors don't trade on perfect information. They trade on perception, confidence, and signals of risk. Outrage functions as one of those signals now, a kind of emotional volatility index that exists parallel to the numerical one. When a hashtag trends for the wrong reasons, or when a celebrity publicly denounces a company, it triggers a cognitive cascade among investors. The question is no longer, is the company fundamentally strong? It's how long will this stay in the headlines and what will it do to sentiment? Because sentiment, more than spreadsheets, drives momentum in a media saturated market. With Netflix and Disney, we saw this play out in real time. The backlash wasn't about accounting errors or market mismanagement. It was about perceived moral misalignment, and that was enough to shake investor confidence. Fund managers who increasingly rely on algorithmic tools that scan social media for sentiment data read the outrage not as noise, but as predictive information. When the tone of online conversation shifts from excitement to hostility, these systems interpret it as risk. It doesn't matter whether the outrage is rational, manufactured, or even factually accurate. The market moves as if it is real because is reality in modern finance. So, this feedback loop means that outrage has effectively become a policy lever within financial decision making. When investors sense cultural instability around a brand, they hedge. When they see moral clarity or strong public defense, they reward. It's an emotional calculus dressed in economic language. You can even track how companies preempt this by shaping investor communications to address not just performance metrics, but public controversies, moral positioning, and diversity optics, all of which influence sentiment analysis. In other words, the investor class has learned to interpret culture like a market signal. This dynamic now reveals to us how fragile confidence really is. Outrage is volatile, contagious, and sometimes entirely artificial, yet it holds enough power to shift billions in valuation because it influences the one thing depends on: belief. And belief, once it is shaken, takes far longer to recover than profits do. What we're witnessing is the financialization of emotion, where anger, moral panic, and social division get converted into actionable training data. Outrage in this context isn't just cultural noise, it is a leading indicator. Executives know that silence can be read as complicity, but overreaction can appear opportunistic. So the middle ground becomes performance, a show of accountability meant to reassure audiences, investors, and regulators that the company still stands on the right side of the issue. Statements are drafted, donations are announced, internal reviews are publicized, and values are reiterated in language that sounds human but is strategically crafted to contain financial fallout. These gestures create the illusion of moral clarity, but they are ultimately instruments of stability, tools for managing volatility in both reputation and revenue. What is fascinating is how this theater operates on two levels. Externally, it reassures the public that the brand embodies shared values, and internally, it signals to employees and investors that leadership is in control of narrative risk. The moral act becomes a business function. Outrage forces the company to rehearse integrity, to display conscience, to show that it is listening. But the true audience is not always the consumer, it is the market, the shareholders, the algorithms tracking sentiment. In the modern economy, virtue and value have become intertwined, and outrage provides the stage where both must convincingly perform. There's one thing executives and creators should take away from this is that outrage is not chaos, it's patterned behavior. It follows cycles, it rewards certain triggers, and it moves through predictable channels of amplification. The mistake many make is treating outrage as a random act of public emotion, when in reality, it's an ecosystem with rules, rhythms, and predictable consequences. Understanding those rhythms is now as essential as understanding your balance sheet or your analytics dashboard. For corporations, that means that planning for outrage the way you plan for a supply chain disruption or cyber security breach. Scenario planning should include not just crisis response, but emotional forecasting, identifying which themes, which partnerships, or creative choices are likely to activate moral reaction online. For creators, the lesson is similar. Recognize the signals before they escalate. Monitor who amplifies your work and why, and build systems that can absorb digital turbulence without derailing your core message. The best companies and creators don't just respond well to outrage, they preempt it by building reservoirs of trust and clarity. They engage directly with their communities long before a crisis even hits, not to manipulate sentiment, but to establish their credibility. Because once outrage surfaces, the real determinant of survival isn't whether you are right or wrong, it's whether you have earned enough narrative capital to withstand the storm. Outrage cannot be avoided, but it can be redirected, absorbed, or even leveraged if you understand that it's not just emotion, it's energy. And energy can always be managed. When we step back from the specifics of Netflix and Disney, a larger pattern starts to emerge, one that has profound implications for the way corporations operate, for how culture is produced, and even for the way policy decisions are made in an age of instant connectivity. What these cases reveal is that public outrage is no longer peripheral or incidental. It has become a kind of invisible governance mechanism, a force that guides decision making across multiple layers of society. Executives monitor it not just for brand protection, but because it has tangible consequences for leadership behavior, for creative strategy, investor confidence, and ultimately market stability. Outrage is no longer just an emotion expressed in the comment section. It has been institutionalized, codified, and in many ways monetized, serving as a signal and as leverage simultaneously. For content creators and corporate leaders, this means that decisions are increasingly influenced by the anticipation of social reaction. Storylines, casting choices, marketing campaigns, and even corporate partnerships are evaluated not solely for profitability or artistic merit, but for their potential reception in a highly reactive social landscape. The same principle extends to leadership. Executives are judged as much on their perceived moral alignment as on their strategic acumen and reputational misalignment. And reputational misalignment can create immediate, measurable impacts on market behavior. Investors, aware of the volatility that public anger can trigger, incorporate these signals into risk assessments and capital allocations, further reinforcing the power of outrage as a governance tool. The broader implication here is that we are witnessing a shift in authority structures. Cultural and economic power no longer resides exclusively in boardrooms or production studios. It now exists in the networked interactions of audiences who, through amplification and engagement, can move markets and shape organizational priorities. Outrage operates as a form of informal governance because it enforces accountability, dictates acceptable behavior, and even prescribes corrective action, all without formal legislation or regulation. It's performative, contagious, and immediate, yet it also systematically observed and strategically managed by those in positions of power. Netflix and Disney provide a clear illustration, but the phenomenon is much larger. From social media trends influencing advertising budgets to viral campaigns reshaping public policy, we see the invisible hand of outrage guiding decisions that were once solely the domain of executives, financiers, and policymakers. What was once a spontaneous reaction has evolved into a structural feature of modern governance, where perception and sentiment dictate strategy as much as logic or law. In this new landscape, understanding outrage is no longer optional. It is essential for anyone navigating media, markets, or culture at scale. It's clear that outrage is no longer a random or external force. It's leverage, a tool that can shape decisions, influence markets, and dictate the direction of culture itself. Companies that fail to recognize this risk not only financial loss, but reputational damage that can linger long after the initial storm passes. Conversely, those who anticipate, understand, and strategically engage with public fury can turn it into an opportunity, using it to reinforce credibility, guide creative choices, and even influence investor confidence. The cases of Netflix versus Elon Musk and Disney versus Jimmy Kimmel reveal a world in which social sentiment, amplification, and performative anger are woven directly into the fabric of corporate decision making, and the stakes are unmistakably high. The key lesson is that understanding outrage as a form of policy is not optional in today's interconnected cultural economy. It is essential for anyone trying to navigate it successfully. Stay sharp.